Everyone wants to teach you how to raise money. Pitch decks, warm intros, valuation tricks. But nobody teaches you the skill that actually saves companies, knowing which money to refuse. Because bad money is more expensive than no money. It costs you your board, your exit, sometimes your entire company. And here's the worst part. You sign up for it voluntarily. In the next 5 minutes, 5 kinds of checks you should tear up no matter how much you need the cash. Let's start with the one hiding inside the contract. Imagine this. A founder builds a company for 8 years, sells it for $50 million, and walks away with 1.6 million. Not 50, 1.6. How? 2 words buried in the term sheet. First, liquidation preference. The investor put in 15 million with a 2x preference. That means before anyone else sees a dollar, they take 30 million off the top. Second, participating preferred. After taking their 30 million, they also get their ownership share of what's left. They get paid twice. Add the other shareholders, and the founder's slice of a $50 million exit is this. 1.6 million for 8 years. The money looked great on announcement day. The contract was the trap. So check 1. Never stack preferences above 1x. Check 2. Never accept participating preferred without a cap. But sometimes the contract is clean, and the problem is the person signing it. Here's what nobody tells you about taking investment. It's not a transaction. It's a marriage. 7 to 10 years. And there is no divorce. So check 3 is the investor themselves. 4 red flags. 1. They don't understand your space. Every board meeting becomes an education session at your expense. 2. Pressure to sign fast. This offer expires Friday. Real investors respect diligence. Manufactured urgency is a tell. 3. You didn't reference check them. And here's the trick. Don't call the founders from their winning investments. Call the founders from their failed ones. How an investor behaves when things go wrong is the only reference that matters. 4. Their clock, not yours. A fund near the end of its life needs you to exit fast, whether it's right for your company or not. Good terms, wrong partner. Still bad money. And then there's money that looks perfect until you try to grow. These are the subtle ones, the traps that don't look like traps. Trap 1, strategic money. A big corporation invests, and buried in the deal is a right of first refusal on your acquisition. Sounds harmless. But now every one of their competitors is off your buyer list. You just made your company unsellable to half the market for a check. Trap 2, too much money, too early. A huge round at a huge valuation feels like winning. But now you have to grow into that number. Miss it, and your next round is a down round. Investors get spooked, employees' options go underwater, and the spiral feeds itself. Trap 3, venture debt. Cheap when things go well. But debt comes with covenants, and covenants hand your lenders the steering wheel at the exact moment things get hard. Checks 4 and 5, money with strings on your exit, and money with a clock on your survival. So how do you judge any check that lands on your desk? Here's the rule. The quality of money equals terms times investor times timing. It's multiplication, not addition. If any one of those is a 0, the whole thing is a 0. Great investor with brutal terms? 0. Clean terms from the wrong partner? 0. And here's the part founders forget. You're allowed to walk. Saying no to bad money isn't losing a deal. It's dodging one. The best founders aren't the ones who can raise the most. They're the ones who know what to refuse. Now I want to hear from you. What's the worst term sheet story you've ever heard? Drop it in the comments. The wildest one becomes a future video. This channel is about understanding capital, where it flows and where it shouldn't. Big things coming. See you in the next one.